How to use a credit card to build credit. Having a strong credit score is important for a lot of reasons. Strong credit makes it easier to get approved for loans and credit cards. It can also make you eligible for better interest rate or credit card offers when you borrow funds. Not to mention, if you're looking to rent or buy a house, your credit score will likely come into play as an indicator of your ability to handle payments. One of the ways you can build up your credit score is through the responsible use of your credit card. So, how do you build a good credit score with your credit cards? In this episode, you'll learn 10 ways to build up your credit score using credit cards. Plus, one trivia question about credit cards. Today's trivia question is, which is the first credit card in history? We've also included the timestamps in the description below if you want to revisit any particular section of the video. 10 ways to build credit using your credit card. 1. Check your credit score. The first step towards building credit with your credit card is to regularly check your credit score. You can use the service of a credit bureau to get a look at your current credit score. Credit scores are grouped into these 5 categories. Exceptional, 800 to 850. Very good, 740 to 799. Good, 670 to 739. Fair, 580 to 669. Very poor, 300 to 579. With the knowledge of your credit score, you can determine which card is best for you. 2. Apply for a credit card with good rewards. Once you've established some credit history, you're probably ready to apply for your own credit card. Any credit card worth having these days will come with a suite of benefits and rewards, whether it's bonus points, cashback on qualified purchases, or travel perks. Some of the top-tier credit cards levy an annual fee as high as $450, but there are many great, no-fee credit cards to choose from. You can apply for a credit card online and the bank will perform a hard inquiry on your credit report. It usually only takes a few minutes to get approved unless the bank needs to verify your income. 3. Consider a secured credit card. You may try a secured credit card to start building credit on your own. With a secured credit card, you can make a cash deposit to a bank or financial institution to establish a line of credit and then use the card to make purchases up to that limit. When you pay the bill each month, the bank will report your payment activity to the 3 credit bureaus, Equifax, TransUnion, and Experian, which will each establish a credit report in your name. If the bill ever goes unpaid, the bank can keep your deposit. If you pay on time consistently, you should eventually qualify for a non-secured card and may even be upgraded by your bank. Once your score is high enough to be approved for better cards, you can consider closing your secured card if you wish to save money. Your deposit will be refunded if your account is paid in full. Your secured credit card issuer may even invite you to upgrade your card to an unsecured credit card after a period and refund your deposit. 4. Check your credit limit. When the bank approves you for a credit card, it will set a credit limit based on your income and other factors in your credit report. The amount of your total available credit limit that you spend each month becomes your credit utilization rate. You want to aim for a credit utilization rate of 10% or less to maintain a good credit score. The more lines of credit you have, the easier it gets. If you consistently keep your spending below the limit and make on-time payments, the bank may automatically increase your limit. You can also call and request a credit limit increase. If you're still not sure how to check your credit limit, make sure you hit that subscribe button and stay tuned for our future episode covering that topic in detail. 5. Always make your payments on time. Your credit score measures how you manage debt, borrowing money and repaying it. To have good credit, you need a record of on-time debt payment. If you never had to make such payments, you don't have good credit. You have no credit. If you're not already making payments on a loan, putting regular expenses on a credit card helps you establish credit without going into debt. Just pay off your credit card bill in full and on time each month, and the card issuer will report your payments to the credit bureaus. By paying in full, you also won't have to pay interest. Your payment history makes up 35% of your credit score, so this is one of the best things you can do to build your credit. 6. Treat it like a debit card. One potential danger of using credit cards is that your bank account balance doesn't change when you make purchases. It's only when you pay your credit card bill that money comes out of your account. So if you're not careful, you can lose track of how much you're spending. It's always wise to keep a budget whether you're using credit cards or not, so you know how much you have available to spend. Treat your credit card like a debit card, spending only what you know you'll be able to pay in full when the bill comes. The more focused you are on spending within your means, the easier it will be to avoid carrying a balance and paying high interest. 7. Know your annual percentage rate, APR. Every credit card has an APR, or annual percentage rate, which is the percentage of your outstanding balance you'll be charged for keeping a balance on the card past the payment due date. The APR on a credit card depends in part on your credit history and can range from 17% to 26%, though some cards offer introductory APRs as low as 0% that last for a few months after opening the card. Some banks raise your APR if your payments are late. Ideally, you shouldn't be concerned with the APR if you plan to make full and on-time payments on your credit card. But it's still smart to choose a credit card with a low APR in case you do end up carrying a balance at some point. High interest rates can quickly snowball your debt. 8. Keep your balances low, or better yet, non-existent. The second most important factor in your credit score is the amount you owe, which accounts for 30% of your score. In addition to considering how much you owe overall, your credit score looks at your credit utilization, or the amount you owe as a percentage of your available credit. The higher your utilization, the more likely it is that you'll be overextended and may miss payments. Keeping your credit card balance relatively low then can provide a significant boost to your credit. Aim for 30% or lower. Keep in mind that even if you pay off your credit card bill in full by the due date each month, you may still have high utilization. The balance on your monthly statement is generally the amount that card issuers report to the credit bureaus. To keep utilization low, consider paying twice a month rather than waiting for your statement to come. 9. Keep your old credit cards open. The longer you use credit, the more predictable you are to lenders. So the sooner you open a credit card and start using it responsibly, the better. And keep your accounts active and open. We don't recommend opening credit cards just to get a sign-up bonus and then closing them. Rather than shuffle from one card to another, find a card that meets your needs and keep it. Every time you open a new credit account or close an old one, it lowers the average age of your account, which can hurt your credit score. The length of your credit history accounts for 15% of your credit score. 10. Carefully review your options. If you're just starting out with credit or have made some mistakes in the past, it's unlikely that you'll get approved for the best offers out there. The best cards typically require good or excellent credit. Focus instead on credit cards specifically designed for people with bad credit or fair credit. Although their rewards and perks aren't as exciting as those offered by the top cards, they're a good starting point as you do the work to qualify for better offers. Think it can't hurt to apply for cards even if it's unlikely you'll be approved? Wrong. Every time you apply for a new credit card, the issuer will check your credit. These kinds of checks can knock off points off your score. Further, multiple credit card applications in a short period of time can hurt your score even more, since it can signal someone in financial trouble. Using credit cards unwisely can hurt your credit, but that doesn't make credit cards bad. Quite the contrary, responsible credit card use can help you build your credit score without you having to carry debt. However, if ongoing credit card debt or consumer debt in general is the reason your credit is less than stellar, think twice before using a card to build it. Having a high credit limit can be dangerous if you have a history of overspending. So back to our trivia question. Which is the first credit card in history? The first credit card to launch was Diners Club in 1950. The card was used to make purchases at multiple retailers. Diners Club was a new twist on an ancient practice. That's it for this episode. Please give us your feedback in the comment section below. To watch more episodes on financial topics like this, hit that like and subscribe button. If you want to support us even more, buy us a coffee from the link in the description. Good luck, and see you in the next episode.